International Accounting Standard 12 Income Taxes. Basic terms: accounting profit, taxable profit, current tax, deferred tax, temporary differences, tax base. What is accounting profit? Accounting profit is a profit or loss for a period before deducting tax expense. Taxable profit or tax loss is the profit or loss for a period determined in accordance with the rules established by the taxation authorities upon which income taxes are payable or receivable. Current tax is the amount of income tax payable or recoverable in respect of the taxable profit or tax loss for a period. Deferred tax liabilities are the amounts of income taxes payable in future period in respect of taxable temporary differences. Deferred tax assets are the amounts of income taxes recoverable in future periods in respect of deductible temporary differences, the carry forward of unused tax losses, and the carry forward of unused tax credits. Temporary differences are differences between the carrying amount of an asset or liability in the statement of financial position and its tax base. Temporary differences may be either taxable temporary differences, which are temporary differences that will result in taxable amounts in determining taxable profit or tax loss of future period when the carrying amount of the asset or liability is recovered or settled, or deductible temporary differences, which are temporary differences that will result in amounts that are deductible in determining taxable profit, tax loss of future period when the carrying amount of the asset or liability is recovered or settled. Recognition: current tax for current and prior periods shall, to the extent unpaid, be recognized as a liability if the amount already paid in respect of current and prior periods exceed the amount due for those periods. The excess shall be recognized as an asset. A deferred tax liability shall be recognized for all taxable temporary differences except to the extent that our deferred tax liability arises from the initial recognition of goodwill or the initial recognition of an asset or liability in a transaction which is not a business combination and at the time of the transaction affect neither accounting profit nor taxable profit or tax loss. Example: an asset which cost 150 has a carrying amount of 100. Cumulative depreciation for tax purposes is 90 and the tax rate is 25. Here, tax base of the asset is 150 less 90, that is 60. Carrying amount of the asset 100. Taxable temporary differences 100 less 60, that is 40. So the deferred tax liability will be 25% of 40, that is 10. A deferred tax asset shall be recognized for all deductible temporary differences to the extent that it is probable that taxable profit will be available against which the deductible temporary differences can be utilized, unless the deferred tax asset arises from the initial recognition of an asset or liability in a transaction that is not a business combination and at the time of the transaction affect neither accounting profit nor taxable profit or tax loss. Example: An entity recognizes a liability of 100 for accrued product warranty cost. For tax purpose, the product warranty cost will not be deductible until the entity pays claim. The tax rate is 25%. Here, tax base of the liability is 0. Carrying amount of the liability is 100. Deductible temporary difference will be 100 less the tax base 0 equal to 100. Deferred tax asset will be 25% of 100, that is 25. Unused tax losses and unused tax credit. A deferred tax asset shall be recognized for the carry forward of unused tax losses and unused tax credit to the extent that it is probable that future taxable profit will be available against which the unused tax losses and unused tax credit can be utilized. Measurement. Current tax liabilities or asset for the current and prior period shall be measured at the amount expected to be paid or to be recovered from the taxation authorities using the tax rate and tax laws that have been enacted or substantively enacted by the end of the reporting period. Deferred tax asset and liabilities shall be measured at the tax rate that are expected to apply to the period when the asset is realized or the liability is settled based on tax rate and tax laws that have been enacted or substantially enacted by the end of the reporting period. The measurement of deferred tax liabilities and deferred tax assets shall reflect the tax consequences that would follow from the manner in which the entity expects at the end of the reporting period to recover or settle the carrying amount of its asset and liabilities. Example: an item of property, plant and equipment has a carrying amount of 100 and a tax base of 60. A tax rate of 20% would apply if the item were sold and a tax rate of 30% would apply to other income. The entity recognizes deferred tax liability of 8, that is 40 into multiplied by 20% if it expects to sell the item without further use, and a deferred tax liability of 12, 40 multiplied by 30% if it expects to retain the item and recover its carrying amount through use. Deferred tax asset and deferred tax liabilities shall not be discounted. The carrying amount of deferred tax asset shall be reviewed at the end of the reporting period. An entity shall reduce the carrying amount of deferred tax asset to the extent that it is no longer probable that sufficient taxable profit will be available to allow the benefit of part or all of the deferred tax asset to be utilized. Any such reduction shall be reversed to the extent that it becomes probable that sufficient taxable profit will be available. Item recognized in profit or loss. Current and deferred tax shall be recognized as income or an expense and included in profit or loss for the period, except to the extent that the tax arises from a transaction or event which is recognized in the same or a different period outside profit or loss, either in other comprehensive income or directly in equity, or a business combination other than acquisition by an investment entity of a subsidiary that is required to be measured at fair value through profit or loss. Item recognized outside profit or loss. Current tax and deferred tax shall be recognized outside profit and loss if the tax relates to items that are recognized in the same or a different period outside profit or loss. Therefore, current tax and deferred tax that relates to items that are recognized in the same or a different period in other comprehensive income shall be recognized in other comprehensive income. Directly in equity shall be recognized directly in equity. Presentation. An entity shall offset current tax asset and current tax liabilities if and only if the entity has legally enforceable right to set off the recognized amount and intends either to settle on a need basis or to realize the asset and settle the liability simultaneously. An entity shall offset current tax asset and current tax liabilities if and only if the entity has legally enforceable right to set off the recognized amount and intends either to settle on a need basis or to realize the asset and settle the liability simultaneously. An entity shall offset deferred tax asset and deferred tax liabilities if and only if the entity has legally enforceable right to set off the current asset against current liabilities and the deferred tax asset and deferred tax liabilities relate to income tax levied by the same taxation authority on either the same taxable entity or different taxable entities which intend either to settle current tax liabilities and asset on a need basis or to realize the asset and settle the liabilities simultaneously in each future period in which significant amount of deferred tax liabilities or asset are expected to be settled or recovered. Tax expense or income related to profit or loss from ordinary activities shall be presented as part of profit or loss in the statement of profit or loss and other comprehensive income. Disclosure. The major components of tax expense or income shall be disclosed separately. The following shall also be disclosed separately: the aggregate current and deferred tax relating to items that are charged or credited directly to equity, the amount of income tax relating to each component of other comprehensive income, an explanation of the relationship between tax expense or income and accounting profit, an explanation of changes in the applicable tax rate compared to the previous accounting period, the amount and expiry date, if any, of deductible temporary differences, unused tax losses, and unused tax credits for which no deferred tax asset is recognized in the statement of financial position. The aggregate amount of temporary differences associated with investment in subsidiaries, branches and associates and interest in joint arrangement for which deferred tax liabilities have not been recognized.